If you have your money sitting around in a savings account at Chase, Bank of America or Citibank, then your money is literally burning away thanks to inflation. This is just one out of many reasons why keeping all your savings in a regular bank account isn't a great idea. Everyone's talking about where to invest, which stocks, which crypto, which meme coin to gamble on next, but almost no one asks the real question. Why should you invest in the first place? And if your why is strong, you won't struggle to figure out where your money should go. And no, investing isn't just about making more money. That's only a piece of the puzzle. In this video, I'll break down the 4 real reasons why you should invest, whether it's stocks, bonds, ETFs, or even crypto. And stick around till the end because I'll share a few things that, if ignored, could cost you big time. Let's start with the number one wealth killer in the whole world. That's inflation, or as I like to call it, the universal tax. Why I'm calling it a tax? Because if you own even a single dollar, then you pay it. No forms, no filings, just automatically. So what is inflation? It's basically this. Things just keep on getting more expensive. Eggs, gas, internet bills, all of them were cheaper just 2 years ago. And if you are someone who remembers the good old days, you're probably thinking, back in my time, things were way cheaper. You're not wrong, they were. But here's the interesting thing. Inflation doesn't scream, it creeps. It's not noticeable day to day. But zoom out over a few years, prices double, triple even, and your purchasing power takes a nosedive. So why do things get more expensive? There are lots of reasons, but let's talk about the big one, the government. Well, more precisely, the US Federal Reserve. Here's what happens. They print money that increases the supply of dollar in the economy, but the amount of goods stay the same. So now you need more dollars to buy the same stuff. It's not that things are getting more expensive. It's that your money is getting devalued. And here is a fun but a slightly depressing fact. In 2020 alone, the Fed printed about $3.3 trillion. That's nearly 20% of all US dollars in existence at that time. So if you kept your savings in a regular bank account that year, yeah, you basically lit your money on fire. Now let's assume that you were smart. So you kept your savings in a high yield savings account. Good move. Right now they pay around 4% annual interest. Sounds nice, right? Until you remember that inflation can spike up to 9%, like it did post-COVID. ISA is good. It protects your money most of the time. But here's the thing. Why settle for good when you could aim for great? If I invested $100 in 1942, I would have a lot of money right now. And also, I would be dead, which is not super helpful. These kinds of examples always sound impressive. If you had invested $1 in 1920, you would have $7 million today. Yeah, cool, but I'm trying to get rich before I die. So let's fix that. Because compounding doesn't have to take a century. You can use it within your lifetimes, and I will show you how. First, what is compounding? Let's break it down. Say you invested $1,000 in the stock market and it gives you an annual return of 10%. So year 1, you earn 10% of $1,000, that is $100. So your total would be around $1,100, right? In year 2, you earn 10% of $1,100, which is around $110. So now you have $1,210. Notice something?
Yes, so I noticed.
You're earning returns on your returns. In the first year, your return was $100, but in the second year, your return was $110. Yes, this is the main thing in compounding. This is the magic.
I love magic.
Give it enough time, and eventually your profits will outgrow your original investment. Now let's project this forward. If you kept investing $1,000 and gave it around 10 years, then you would have around $2,593. In 20 years, it would be $6,727. And in 40 years, it would be $45,259. All from one-time $1,000 investment. Now adjust that for inflation. And sure, the numbers rings a bit. But even in today's money, that's still powerful. And guess what? The only thing it cost you was your time. But it takes too long. I get it. You're thinking, this won't help me retire early or get rich fast. That's where most people stop.
Give up. Just quit.
But they are missing something important. Ask yourself, are you going to work forever? No, right? Whether you want to retire early or retire normally, Compounding helps you both. Don't be discouraged just because compounding isn't a get-rich-quick scheme. It's a get-rich-reliably scheme.
Very good. It's nice to see there's still somebody I can rely on.
And the earlier you start, the more ridiculous it gets. Chapter 3. Tax Benefits. Look, I don't like giving my hard-earned money to Uncle Sam, and I'm guessing neither do you. Luckily, the government has this strange habit of rewarding you when you do something smart with your money, like investing. And me, I would do literally anything to save on taxes. Legally, of course. Now there are a lot of tax benefits, way too many for one video. But let me show you just one example that will blow your mind a little. Capital Gains Class 101. Taxes on your investments mainly fall into two buckets. One is short-term capital gains, if you sell under 1 year, and there is long-term capital gains, if you hold for more than 1 year. Let's say you made a profit by selling your stocks. Here is how much tax you would owe. This for single filers. If your income exceeds $500,000, then you would have to pay around 20% tax on your capital gains. And if your income is between $47,000 and $500,000, then you would have to pay around 15% tax on the capital gains. And if your taxable income is below $47,000, then you would have to pay 0% tax on the capital gains. Yes, 0% tax. So yeah, just by holding for 1 year, your tax bill drops dramatically. So what if you lose money in the stock market? Good news, the IRS actually lets you use your investment losses to your advantage. You can offset your losses to reduce your total taxable income. Basically, your losses can lower your taxes. Now here's where it gets spicy. You only pay taxes when you sell your investments. So if your stocks go up but you don't sell, you don't pay anything. That's how billionaires legally avoid taxes. They don't sell their stocks, they just borrow against them. Imagine this, you own $100 million in Tesla stocks. So now you need money. So you borrow $10 million against it. And now you are spending millions tax-free because loans aren't taxed. And this strategy is called buy, hold, borrow, die. Genius, right? Chapter 4. The Positive Economic Cycle. When you invest in the stock market, you're not just trying to make money. You're actually helping the entire economy grow. Here's how. Companies use your investments to hire more people, build better products, and expand. That creates more jobs, which leads to higher incomes. And higher income means people have more money to spend. And if people spend more money, then businesses can earn more. So it benefits everyone, including you. It's a positive feedback loop where growth creates more growth. So yes, investing isn't just good for your wallet, it's good for the country itself. Okay, we have covered all the good stuffs about investing. But before you throw your money into the market and yell,
I'm really rich,
there are a few important things you need to understand. Because if you skip these, you could end up losing your hard-earned money. Number 1. Understanding risk. In the world of investing, risk is the possibility of losing money. It's simple but crucial. Here's a general guide of investments, ranked from least risky to most risky. So there are bonds, which are relatively safer. Then there are index funds. Then there are rental properties. Then you can think of some individual stocks. Then there are crypto. Then there is lottery tickets, which are extremely risky. The more risky the asset, the higher the potential returns, but also higher losses. You gotta find where your risk tolerance sits. Or you can just always mix it up and diversify. Like you can invest 30% in bonds, 50% in index funds, 10% in real estate, and remaining 10% in crypto and other meme coins. This is just an example. Adjust it based on what feels right for you, based on your risk tolerance. Number 2, time horizon. How long are you planning to hold your investments? So see, if you are investing for a long period of time, then you are likely to get more benefits. Like there are tax savings from the government, and also the benefit of compounding can only be utilized in the long run. And sometimes what happens in the market is stock market crashes, and if you sell in panic mode, you lock losses. And that's why you should have emergency fund. You need to have cash saved for emergencies before you invest. Keep around 3 to 6 months worth of expenses in a savings account, preferably a high yield one. This way, if life throws a curveball, you won't have to cash out your investments at a loss. And if you are young, in your teens or early 20s, here is some wisdom. Invest in learning first. Investing in your education will give you far higher returns than the stock market ever could. If you want to learn investing, then that's great. You can start early. You will learn a lot of things, like you will learn discipline, patience, and how not to lose your money in a crash. So if your why is clear, why you want to invest, why you want to beat inflation, why you want your money to work while you sleep, then congrats, you're probably ready to start. But now the real question is, how do you invest? Where should you start? Crypto, stocks, bonds, ETFs, golds, Pokemon cards? Don't worry, I've got you covered. Just hit that subscribe button and stick around. Till then, bye.